Cenovus Energy is currently the cheapest big Canadian oil and gas stock on a forward-looking price earnings basis, with an enterprise value to sales below 1. What am I missing here? Why is this company so cheap? Today, I'm going to dive into this company, do a little bit of research, and see what I can find out exactly makes Cenovus Energy such a special deal right now in the market. Hi, my name is Liam. On this channel, Golden Larch Investing, we talk all about investing in Canada. I've had the opportunity over the last couple of months to talk about a lot of stocks, a lot of companies, about the market in general, about trends that I see, about all sorts of things. And today's honestly a really special opportunity because this video was requested by a viewer. Big shout out today to Matthew Russo. I think I'm saying that right. Sorry if I'm not, because he left me a comment on a previous video asking me to look into these guys. And I thought, hey, worth a shot, right? I'll look into the company. And I am so thankful that he did, because at face value, this company is probably the most undervalued Canadian oil and gas stock. And I can't seem to find a lot of catches as to why they're so undervalued. So let's talk a little bit about who exactly this company is, what they do, what makes them special, what I'm talking about when I'm talking about their undervaluation, what I mean when I'm saying their price to earnings on a forward-looking basis is so cheap, talking about enterprise value to sales, all of these kind of ratios that are helping me sort of evaluate this company. And then we'll talk about whether or not it's probably making it into my portfolio. And spoiler alert, it probably is. So stick around. Let's talk about Cenovus. Okay, a couple special things about this company. First, right on their website, they trace their roots back to 1880s when the Canadian Pacific Railway was building its way across Canada. And in Alberta, in the south of Alberta, they found natural gas. Obviously, that sort of discovery and subsequent discoveries all around Alberta have made a giant change to not only this province, but the whole country, and has built this industry. So they're saying our origins start way back at the beginning. They've expanded throughout the years to today being the second largest producer of Canadian oil and gas. So they're the second place, a huge player. And there's been a couple of big things that have happened recently. I also want to talk about what exactly they do, because these guys are pretty unique. They are both an upstream company, which means they produce the actual oil and gas, they extract it from the ground, and they sort of get it ready for shipment. They're a midstream company, so they do own infrastructure on which they ship their gas, and they're a downstream company, which means they do own like export capacity and refining capacity. So they play in like all these different parts of the oil and gas industry, which isn't something that all companies do. Famously, I've talked a lot about midstream companies on this channel, which are the guys that take it from the producer and bring it to the refiner, because that's been really profitable. But these guys are saying, hey, we can produce it, we can move it, and then we can refine it. And that's going to bring efficiencies in our business because we are sort of vertically integrated in that way. There's a couple other huge things that have come up with this company. But I think it's important to note that very recently they had a massive acquisition. Again, a common trend here when we're talking about these Canadian oil and gas stocks. And this time we're talking about the acquisition of Husky Energy. Now, if you're Canadian, you've probably heard that brand name, probably seen it around. These guys do a lot of different things, but sort of the most front-facing thing they do, there's gas stations that are Husky. There's a lot of commercial sort of gas stations and big truck infrastructure there that is owned by Husky. And so you'll see these guys on the sides of the highways or in different towns and cities across particularly the west of Canada. Fairly common brand name. I think that there might be a little bit of an indication that this recent acquisition of Husky Energy is some of the cause of Cenovus's undervaluation. Now, I need to be very specific. I'm not saying the acquisition is bad or that they're losing money, but what I am saying is that they did take on a lot of debt. They massively expanded their business. Their dividend has been cut down recently, whether that's because of the Husky acquisition and the associated debt or because of other sort of cost issues. I'm not 100% certain, but all of those things sort of happened at the same time. So some investors who maybe were looking for one thing from this company suddenly see another and are out. But what Husky and that acquisition did do is it grew them in size. It brought them a bunch more assets. It brought them a bunch more production capacity. And a bunch more proven reserve. So a lot of really cool stuff that Husky brought along to Cenovus here. Now, speaking about debt levels, when I see a company like Cenovus, like all of these companies we've talked about, honestly, in Canadian oil and gas, nowadays, one of the things that I want to look at is their debt levels. Because I've talked about BCE a million times on this channel. I feel like I keep punching down on these guys. But obviously, debt can be a big burden on a company that's trying to expand and acquire and build out infrastructure, right? So a company like this that does own all this midstream infrastructure and all this equipment, and they have to maintain it and spend all this money, they often have big debt loads. But these guys have very, very smartly executed a debt plan, and they've hit all of their targets. And from what I've seen from Cenovus investors on the internet, that's not surprising. These investors expect this management to be able to do this because they've shown they can do it in the past. They are able to take on big loads of debt, get it off the books, and move forwards. And one of the really interesting things they've said in their most recent earnings is that since they have managed to cut down so much debt from this recent acquisition, they're focused on returning 100% of cash flows to investors. And excuse me, I should say excess cash flows. So 100% of what they don't need for this business is going back to you and me as an investor. One of the ways they've done this, share buybacks. So they've been buying their own shares back from the market, reducing the overall float, and so increasing ownership stake. And of course, they've been increasing their dividend. Their dividend today is back up to about where it was when this company first sort of came into existence. And so having these sort of objectives right now seems like a really good opportunity going forwards. And I think these share buybacks might help us understand a little bit why these valuations looking forwards are so positive, because by buying back shares, they're sort of changing the denominator on a bunch of things. But that still doesn't explain why exactly their price to earnings and their enterprise value to sales ratios are so cheap compared to their competitors. One of the key reasons I think that might be behind this is uncertainty. Now, uncertainty in the stock market seems to be everywhere right now, but in these sorts of companies that are expected to be stable, cash flowing, dividend growth sorts of investments, right? Oil and gas, you're thinking midstream, you're thinking about Enbridge probably, you would expect stability. You'd expect a solid concrete plan that stays the same. The issue with a company like this is that they've cut the dividend, and they've cut it many times. On these charts, the first time I'm seeing is really that 2015 through 2016 era. Really tough time for Canadian oil and gas. Makes a lot of sense that the dividend cuts would have come then, but also a cut down to zero sort of throughout the pandemic there. And then you've seen some other cuts throughout their lifetime. So dividend growth investors might be looking at these guys and saying, okay, maybe they'll continue to return cash flows to me as an investor, or maybe they'll have a change of heart and cut it in the future. And that uncertainty can dissuade some investors. One thing the dividend cuts haven't done, however, is slow down their stock price at all. If you just look at this chart of how the stock has gone over the last 10 years, there's been a lot of up. Now, obviously, it's not a perfectly straight line. No company ever is. But with valuation so low, this growth could be a great opportunity. Now, just about all the numbers I see for this company have been positive. It looks like they're going to sort of keep revenues the same or maybe a little bit up. It looks like their price to earnings ratio is going to continue to look better and better. It looks like they're significantly under the fair value analysts have put on this company. It looks like they're going to be able to return cash to investors in serious quantities in the near future. And so I'm not seeing a catch. Now, I need to point out here that I have not had the time in the last few weeks to know everything there is to know about this company, and there could be things I'm not seeing. I haven't evaluated the value of their assets versus what they say they're worth. I haven't had the time to go through and see if people agree with what they say their proven reserves look like, or any of that really, really in-depth stuff that you might want to do before making a purchase decision yourself. However, from this sort of face value perspective, from the bird's eye view that I have on this company, it looks really good. Like really, really good. And as I sort of research a little bit more into this company, man, keep adding oil and gas stocks, but it might just have to make the portfolio. Like, it doesn't make sense. If it is not, if there's no catch, if it is what it looks like, it doesn't make sense not to be buying this company, considering what else is in that portfolio. Now, this is where I ask you, as the audience here, please let me know. Do you agree? Do you think Cenovus is a great buy? Do you think there's a catch? Is there something that you see that I have missed? And I would love to hear that, particularly before the end of the month, when I might be making my sort of next round of decisions on this portfolio. And apart from that, if you've made it this far in the video, please leave a like, subscribe to the channel. It means a huge amount to me. We try to talk about Canadian stocks every week on this channel. And I will see you all in the next video.